be 10.
Good morning, students. I hope you all are doing well and enjoying your studies also. So, we are starting with the topic books of original entry. That is, books of original entry means we are going to see how we are writing the entries in the books of accounts, right? And books of original entry is a journal book. Let us see that. In the preceding pages, you learned about the debits and credits and observed how transactions affect accounts, right? This process of analyzing transaction and recording their effects directly to the accounts is helpful in learning exercise. However, real accounting systems do not record transaction directly in the account. The book in which the transaction recorded for the first time is called journal or book of original entry. Right, so I had given you in the beginning only it is said is journal book, or here you can see books of entry. Please underline that line. The books in which transactions is recorded for the first time is called journal or book of original entry. The source of documents, as discussed earlier, would be your bills and all that, right? Vouchers required to record transaction in the journal. You should have proof, whatever you are recording. I cannot write the journal entry of purchase or sale or expense in the ad If I'm showing purchase of 50,000, so I need a proof. Then only my journal entry will be verified and corrected, right? So that's why it require proof, right? This practice provides complete record of each transaction in one place and links the debits and credits of each transaction. After the debits and credits for each transaction are entered in the journal, they are transferred to the individual's account. The process of recording transaction in journal is called journalizing. Once journalizing process is completed, so how you are going to follow step by step, right? Once you journalize, you write the common entries, then what is the next step? Complete the useful description of events affect the organization. The process of transferring journal entry to individual account is called posting. Individual accounting means suppose you had purchased goods of rupees 5,000 in cash. So here two accounts are affected. Purchase account, that goods comes in and cash goes out. So purchase account debit to cash account. So two accounts are affected. So journal entry will be passed in journal book. First will be the entry would be purchase account debit to cash account. Amount 5,000, 5,000. Now next step what I am going to see prepare a purchase account separately and a cash account separately. Right. In purchase account I am going to write to cash 5,000, right? And in cash book, cash account, I am going to write by purchase, right? So that is posting. This sequence causes the journal entry to be called book of original entry and the ledger account as principal book of entry. So book of original entry is your journal book, underline that line, and principal book of entry is your ledger. Journal is subdivided into number of books or original entry as follows. Journal proper, cash book, other day books. Other day books here means subsidiary books that are your purchase book, sales book, purchase return book, sales return book, bills receivable book, bills payable book. In this chapter, you will learn about the process of journalizing and then posting into ledger. The cash book and other days are books are dealt in detail in 4th chapter journal. Now, this is the base of your account. If you are not able to write journal entries, students, it will be very, very hard for you to write posting of the ledgers, right? Then journal proper, then you will be having difficulty in writing the accounts also. So, this is the base. If you have any doubts, you can ask me personally. You can see this is the journal. Pro forma can be seen by you. Can you see the pro forma? You should follow the pro forma. Pro forma also carries the mark. Journal, here it is a date column on which date it is recorded for that particular month. Particulars means purchase, cash, sales, salary, whatever the thing is. LF, that is ledger folio number, debit amount, credit amount. Suppose my entry goes like this. Purchase goods of rupees 5,000 in cash. So my entry would be 1st of November. Journal entries date is 1st of November. So my entry would be purchase account debit. So that debit amount I am going to write over here 5,000 to cash account here 5,000. Is it clear? Right? So brief description of okay, narration is to be written. You can see over here transaction. Is it clear? The pro forma is clear to you. For example, goods purchased on credit. Credit means here the name of the party will be given. For 30,000 from MS Govind Traders on December 24, 2017. Involves only two accounts, that is purchase account and MS Govind Traders account. So date is written over here. Can you see over here? Date 2014 December 24. It is compulsory to write. If you miss this date, your entry goes wrong. I'm not going to give you marks. Then We had purchase. Purchase account is a real account and going traders is a personal account. So real accounts rule is that debit what comes in. Purchase account debit because goods comes in. Going traders account because going trader is a giver. Right? So 30,000. This is narration. Purchase of goods in trade from going traders. And students, what are your purchases and sale? Only the things in which a businessman deals. Suppose a businessman is having a grocery shop. So he will be having his goods as groceries. Vehicles will not be his goods. Whenever the word goods is given, so purchase is there. But if he buys a vehicle of rupees 50,000, so that vehicle is termed as vehicle because it's an asset for him. Right? It will be noticed that although the transaction result in an increase in stock of goods, the account debited is purchase, not goods, right? Because it is deal in business. The goods account is divided into five accounts: purchase account, sales account, purchase return account, sales return account, and stock account. What is purchase account? The goods that you had purchased. What is sales account? The goods that you are selling. What is purchase return account? That the goods you had purchased and that are not fit according to the your requirement, you are returning them, that are purchase return account. Sales return account, the goods that you have sold and there is certain defect, so it's not according to the choice of the customer, they are returning it back to you. It's termed as sales return account, right? Then what is stock account? Stock account is similar to goods, but the goods that are left with you in the stock is termed as stock account. When the number of accounts to be debited or credited more than one, entry made for recording the transaction is called compound journal entry. That means compound journal entry involves multiple accounts. For example, office furniture is purchased from Modern Furniture on July 4, 2017 for 25,000. 5,000 is paid by cash immediately and balance of 20,000 is still payable. Again, I am repeating, students. Office furniture is purchased. So, this purchase is not your goods. It is furniture. Purchased from Modern Furniture on 2017 for 25,000. 5,000 is paid in cash. Right. So, your journal entry will go like this. Here you can see some amount is paid in cash, that is 5,000. Other 20,000 will be paid in future. So, it means a credit transaction is there also and a cash transaction is also there. Right. So, furniture is analyze it. Furniture is your asset. Asset means real account. Then uh, what goes out? Cash goes out. So cash is also a real account, right? And your modern furniture is your personal account. So debit the receiver, credit the giver. Modern furniture is a giver. So entry will be like that. Furniture account debit 25,000 to cash account 5,000 to modern furniture account 25,000. Can you see? Office furniture account 25,000, cash account, two cash account 5,000, two modern furniture art. Now, what is the basic question, student? How you are going to analyze? So for that, I am giving you a format. There are three types of account: real account, real account, personal account, nominal account. So your real account includes all the assets. All the assets means current assets also and non-current assets also. Personal account includes name of the person or name of the business firm. Okay, nominal account is there. Then nominal account means expenses and losses income and gain. Right, these are some basic. Then rules. Debit what comes in, credit what goes out. Because it's an asset, right? Then for personal account, the rule is different. For debit, I am using the abbreviation DR, debit, the receiver, credit, the giver. Is it clear? For nominal account, debit, expenses and losses, credit, income and gains. So these are the basic rule of account that every student should know. Right. So assets. Let us go again. Otherwise, you will not be able to understand teacher ये कैसे आ रहा है. Again, I am repeating. There are three types of account: real account, personal account, nominal account. Real accounts are classified through assets. All the assets will come: land and building, machinery, furniture, goods. Right. So purchase and sale is a part of real account. All these. Personal account is the name of the person or a business firm. उसका रूल है डेबिट द रिसीवर क्रेडिट द गिवर. When a business is started with the investment of 50,000, suppose, so cash comes in, so cash account is debited because cash is a real account, and owner is a giver because capital is a personal account of owner, so owner is a giver. So cash account debit to capital. Nominal account, all the expenses, that is your station, take example electricity bill is an expense, so it will be debited. Debit all expenses and losses. Then your interest received, bank interest you are receiving, so that is your income. It will be credited. In the same way, assets like cash, then listen. Real accounts includes assets. Assets, real accounts rule is this. Personal accounts includes name of the personal account, nominal account. Rules for them are: real accounts rule is debit the risk, debit what comes in, credit what goes out. It means your asset when it is purchased or you are getting cash to debit what comes in. Furniture purchase, अभी हमने transaction देखा, so furniture comes in, right? Goods purchase, so goods comes in, so purchase account is debited. Credit what goes out, cash paid, so cash goes out. Is it clear? So these are the rules that you need to understand. So when more than two accounts are affected while doing passing the journal entry, it is termed as what we say compound journal entry. So here office furniture is purchased for 25,000. It's an asset. Office furniture comes in. So furniture account debit. Two cash 5,000 is paid. So cash goes out. That's why two cash. Two modern furniture 20,000. Right? Purchase of office furniture from modern furniture. Now refer examples of one page again. So I'm stopping over here and I hope you all will clearly go through these rules, and everyone has to write this rule 5 times in their book. 5 times in their book. Again I'm repeating, write rules of account of account 5 times in compound. Right? I hope you all are clear what I am saying to you. So these are the rules. Which are the rules? These are the rules. I am ticking over the rules. These are the rules. Debit what comes in, credit what goes out. Debit the receiver, credit the giver. For nominal account, debit the expenses and losses, credit all incomes and gains. Right? Do one task for me. Real account में जो asset आती है उसके नाम लिखिए. Personal account के थोड़े examples के नाम लिखिए. Nominal accounts के थोड़े examples के नाम लिखिए. Expenses and losses, incomes and gains. Then also you will be able to do it, right? So your task is write the rules of account 5 times in homework book and prepare a list of current assets, prepare a list for personal account and prepare a list for nominal account. Till then, take care and bye bye.